Finding an affordable place to live in major cities across the country is not easy, particularly for the tech-rich Bay Area. However, it may get easier, a lot easier, in the near future. Let's take a look. According to Wolf Richter of the Wolf Street blog, it's high time to unload houses and condos in Silicon Valley and San Francisco. Sellers are now flooding the market with properties. Based on information from the National Association of Realtors, Richter points out that inventory has more than doubled from a year ago, as you can see in this chart here. And as the chart shows, the number of active listings has risen in each of the past 3 months, and now we're at levels not seen since 2014. Richter says the red bars signal bubble trouble in the housing market. What seems to be happening is that the buyers are refusing to participate in the bidding wars that have been a big part of the red hot housing sector for years. According to Richter, they see the prices and they do the math, and with the higher mortgage rates, they walk. So motivated sellers have to do something to move the properties, and they started cutting prices. And that brings us to this next chart here, which shows the number of properties for sale with price cuts has exploded by over 400% year over year. And as you also can see by this chart and the previous chart, the trend began in mid to late 2017, but the momentum has been expanding rapidly in only the past few months. And as you can see by this chart here, the increasing inventory and the price cuts are affecting the median asking prices of houses. According to Richter, the median asking price peaked in May at about $1,369,200 and has since fallen by about $132,100 or by nearly 10% to about $1,237,100. Richter further stated that after years of blaming the surging home prices in the area on a shortage of inventory for sale, the industry is suddenly faced with all kinds of inventory coming out of the woodwork, just as sales are slowing and as mortgage rates are rising, and while the affordability crisis bites the market. Richter warns that what's especially worrisome about this trend is that the tech boom is still, for the most part, doing well, and that there are no real signs of a hiring slowdown or layoffs. Further, the tech startup market is also going strong, he says. Richter further stated that though stock prices of local companies such as Google parent Alphabet, Apple, Facebook, and many others have taken a big hit since this past summer, we're still far from a classic tech meltdown. That is yet to come. And if a tech meltdown happens, then what happens to the housing market? So for the last chart, let's go see what's happening with interest rates. It's been a while since we took a look at the 10-year, and this is the 10-year, the CBOE interest rate 10-year T-note, and the symbol is TNX. The close recently was 2.891. That's 2.891%. And as you can see by the price chart, we have been above 3% here recently, and we just came down below 3% in the past few weeks or so. And looking at the chart here, we've got a pretty good downward trend all the way from here in the year 2000 to where we are right now, under 3%. And in my opinion, we may be heading down a little further because it looks like things may have topped out, at least temporary. I'm not quite ready to say that. Looking here at the MAC, it does look like we have a topping process here, but the fast line has yet to go through the slow line. I want to see that fast line move through the slow line, and then that will give me the confidence to say that interest rates may be coming down here. We can always have a reflection at this point when the fast line is above the slow line. So I want to see that pierce, but it doesn't look like it's going to be moving through very quickly. So interest rates could be stubborn. But looking at the histogram, that definitely is showing a downward trend. Looking here, moving on to the price rate of change. Fast line has moved through the slow line there. Relative strength, we're heading down to the 50 or midline. I'd like to see the move below 50 to really say that interest rates are coming down. But by the stochastics, it looks like it wants to come down. Fast line moving through. We are now just below the so-called oversold territory, which is between that upper area of 80 to 100. We're coming below that, but I still want to see it moving down toward that 50 or midline to be able to convincingly say that interest rates are heading down. But at least temporarily, it does look that that's where they are headed. But again, back up to that MACD, I want to see that fast line move through the slow line and see if we can head on down that way. And if that does happen, that's going to be a pretty good indication to me that interest rates are coming down. But for right now, they have gone down just in the last few weeks or so, but we're still above the 20 and 50 EMA. I'd like to see the price there break through that 20 EMA as well. But for now, I think the fact that interest rates have hovered around that 3% level, it's done plenty of damage there. And I think the housing market is starting to show that burden. So we'll have to wait and see what happens here in the future. So we'll be coming back to this again and talking about interest rates relatively soon in another video coming up. So please subscribe and pay attention. And for today, that's ChewDog Charts. Thank you.